All right, welcome in, guys. And now we are going to talk about how you can use this short-term rental loophole to build an entire portfolio, how you can actually build it for real wealth accumulation, for real asset accumulation. And I'm going to tell you kind of how I really think the short-term rental loophole is ideally used. So some people are like, well, we're going to buy it, we're going to manage it ourselves, we're going to do it. I think of it as more of this is a way to build this and then keep building it, right? So let's talk about that and how, let's just break it down with a real life example of how you can use the short-term rental loophole. And now that you understand fully how to do it, materially participating on the property, cost segregations, bonus depreciation, you understand all of that. Now let's put it together with how you can use this to not just get one property 1 year, but to get 10 properties in 5 years or 10 years, like how you can ultimately use this to really build that portfolio up. So year one, you're going to get into the short-term rental game. You're a high earner W-2, late summer, look to buy your property. We have some really good short-term rental connections. I'm going to make sure we share those resources with everyone here too, but these people can help you find properties. They can help you manage them. They can help make sure you're educated and understand what you need to do and that you're doing the material participation, and they can take them off your hands and manage them, right? So these are connections, happy to make them for you. We've networked a lot to make sure we have people in this space who know what they're doing, who are well-versed at it, who are good companies that can do this. So there are ways to do this. But year one, it's late summer, early fall, you buy the property. You find a property, find a smart investment property. You find a smart investment property, it's going to make you money, not just one that's going to save taxes, but yep, this really looks like it can work, looks like it can cash flow for me, looks like it's going to appreciate in value, doesn't look like they're going to outlaw these short-term rental rules here in this ordinance or city, right? But find a good property, get it available and up for rent. So that's step two. You need to get it up. You need to get it up probably by October, November at the latest, because you need to get at least 3 stays in there. The average stay has to be 7 days or less, and you need to create an average. So if you have one stay at 3 days, that's not an average. And the IRS auditor will come in and say, no, that's not an average. So you need multiple stays, right? At least 3. If someone stays 10 days, you definitely need a couple shorter stays to create that average. But in general, you're going to have 3-day stays, 7-day stays, 4-day stays, like few of those stays in the year, but that needs to happen. Get them in there, get a short-term rental going. Then you're going to bring in any repairs that you needed to do. Those are going to have been done, and you're going to get your cost segregation study done. This is going to create huge losses in year one. You're going to have made sure that you materially participated in that property. You're going to use it, create huge tax savings from it, file your returns. If you've overpaid taxes from your W-2, you're going to get those back. $30,000, $40,000 if you're a W-2 and you paid it all in on $500, right? So you're going to get that money back. And then on January 1st of year two, you know, all right, I already materially participated in year one. If you really want to be passive in this thing and you're like, I just want a place that cash flows, that makes me money, you've got the tax savings from that property. January 1st, hand the keys over entirely to the property management company. That property is off your hands as far as that goes. Like you shouldn't, you're going to have to manage and make sure, obviously it's in your portfolio, you own it, but they can manage everything. You no longer need to worry about materially participating because you've taken the bulk of the losses in year one. Year two, that property's job is to cash flow, appreciate in value, and make you money. Now, if it has a loss, which it may still have a loss from depreciation on the normal stuff, you have to do some repairs and things like that. You could still get a paper loss, especially with interest rates, insurance, taxes, things like that. If you get creative about the expenses and deductions that you're getting through there, but just know, if you're over $150,000 in taxable income and you have a loss from that property, you may not end up taking it. It may get shifted into your suspended, but that's okay. That's no longer your concern. You're probably going to have income, and if you have a loss, it's probably going to be minor. If you're really concerned about that, don't hand off the keys. Keep managing that place. But if you're like, no, we're just trying to build something here. I've got my full-time job. I've got what I do to make money. I've got my cash flow income. This is an asset. This is something that's adding additional cash flow. It's a smart investment. It got me my tax breaks in year one, and now it's an asset generating money for me. Year two, late summer, go buy the next one. Early fall, right? Buy it, get it up and running. You're managing this property. You're managing property number two. You're materially participating in it. You could still have it managed, but make sure you're going to meet 100 hours more than anyone else, or 500 on this property, right? You now take your savings, your 40 grand in savings, invested into that property. You had the savings from year one, buy property two, right? Now you have 2 properties. Materially participate in property 2, maybe even got it at a little higher price property, cost segregate it, 100% permanent now. So planning's great for that. Whereas we were all worried about it going down every year here the last few years. Planning's great. Get a huge tax savings again off property 2, January 1st. Hand the keys over. Property management companies handling everything. You got your big losses from property 2. They offset any income on property 1 and created another tax savings for you. They created that money back in your pocket, right? Now, if you wanted to reduce your W-2 taxes, income tax withholdings, you could have done that and just saved the money throughout the year. But if you want to just let it ride and get that big refund, you could do that as well. Those are ways you can create it. And then year 2, rinse and repeat, or year 3, rinse and repeat, right? So now same thing. You've got 2 properties under your belt. being managed. Year 3, you want those savings, buy another one. Just know if you get, year 3, 4, and you decide, you know what, I don't want to buy another one, like you've got the tax savings juice out of these properties. Like, you're probably going to have a little bit of taxable income, maybe you have a tax loss, but the big stuff, it was in year 1 on that property. So if you want to keep getting it, you need new properties, but you could do this, right? For 5, 10 years, like start to get those savings, use those savings to get more properties and wipe out the taxes every year, get big refunds to get it back every year, right? So there's ways where you can do this. And in 5, 10 years, you have 10, 15 properties under your belt, cash flowing, making you money, mortgages are being paid down. So the cash flow is just getting higher and higher, right? So you could have those, they've appreciated, right? You could start to sell them off, 1031 exchange, pull money out of them, be super creative about it, but you're now a full-time investor and you can do all sorts of crazy things. So that's how I see the short-term rental loophole best used. It's how some of our short-term rental professionals, they've been building up their portfolios. And again, that's what they do is you can do this, you can use that leverage. It's just that tax savings is one more piece of leverage that you get to continue building that portfolio. So there's all kinds of different ways you can do it, but to me, that's how it's best used is get the property, materially participate, get the losses, hand it over, get the next property, right? And that's how you can use the short-term rental loophole. That's really what I think the short-term rental loophole is. So be sure to catch the last 2 videos in our series here on the short-term rental loophole, guys, because the next one we're going to talk about avoiding traps, avoiding some of these pitfalls, because there are some little slip-ups, some little quicksands you can get into and you can miss out on the whole savings. It's nothing crazy, but you got to understand it and make sure you don't do that. And then in the last one, we're going to talk about audit proofing, which is probably the most important video in this entire series. So you do not want to miss that one. You want to make sure when you're going to do this short-term rental loophole, you can sleep at night, you're comfortable, and you're ready for anything that comes your way if there is an audit. So we want to make sure that you're equipped for that, but definitely catch the next one on avoiding traps and then that last one on audit proofing.